One fact we all know about Charlie Munger is that he isn't scared to speak his mind. If he does have anything on his thoughts, something he feels that he needs to tell you, he will not hold back. He will tell it to you straight out. In today's video, we will learn why Charlie Munger is concerned about stock market returns in the future decade, from 2022 to 2032. But first, if this is your first visit to our Smart Stocks Academy channel, please accept my best greetings. And to be the first to know when a new video like this is released, hit the like button, subscribe, and click the notification bell next to it. I hope you're ready. Let's get to it. Okay, Charlie Munger was recently questioned about his opinions on stock market returns over the next decade. And here is what he had to say.
My next set of questions are more on the finance side. So Paul Goodson, who has a bachelor's degree in science in 1975, asked, do you expect the next 10 years to have lower returns in the equity markets than the last 10? He doesn't give us an idea why.
The answer is yes.
And could you give us a hint as to why that might come to pass?
Yes, because so many people are in it and the frenzy is so great and the systems of management, the reward systems are so foolish that I don't think it's going to work at all. I think the returns will go down, yes. In real terms, the returns will be lower.
Let me clarify it to people who aren't sure what he is referring about. The fact that everyone wants to invest in stocks is the first thing he discusses. So, in the stock market, we've witnessed phenomenal growth over the last decade. The stock market has increased by more than 500% or more than 5 times since the end of the previous stock market crisis more than a decade ago. This has the effect of causing everyone to swarm the market. What did you invest 10 years ago and now have 5 times the amount? I would love to do the same thing. The chef, the janitor, the professional athlete, they all want to invest their money in the stock market, and prices continue to rise. It reminds me of what happened back in the 1920s. As a result, the 1920s were dubbed the Roaring Twenties. Back then, Ford Model T was selling like hotcakes. The economy was booming and everyone started investing, and they made a lot of money doing so. Until 1929 came around. The market was plainly overvalued, and investors realized that they didn't comprehend their investments, so they sold out, causing the market to fall. It was until 30 years later in 1959 that it was completely recovered. And here is the thing. A lot of individuals who are now invested in the stock market has no idea of market history, preceding lost decades, or anything else. They watch their neighbors and friends becoming wealthy as a result of their investments, and then they want to jump in on the fun. But, as Munger believes, the celebration can only go so long. You can't keep generating limitless returns in the market as much as we'd want to think. Things have to settle down soon, and history knows that this is the case. There can be times when the market is booming and others when it isn't, such as the period from 1929 to 1959. I'm not sure whether you noticed, but Munger also stated that I believe that returns will go down. Returns will be lower in actual terms. So why did he emphasize real returns in particular? In essence, the first question I should ask you is, do you understand what real returns are? After taxes and inflation, the real return on an investment is calculated. Nominal returns, which do not account for taxes and inflation, are lower than real returns. As a result, Munger has focused on the fact that inflation and/or taxes are likely to rise during the next decade. Let's look at taxes first. Unless you've been dwelling underneath a mountain, you're probably aware that the United States has a newly elected president in 2021. Joe Biden is his name. Donald Trump has been replaced by him. The old taxes were not popular with Trump. Indeed, when he first came to office, one of his first big measures was to drastically reduce taxes, particularly the corporation tax rate, which he reduced from 35 to 15%. Biden will be doing the exact opposite, increasing the taxes, specifically more taxes on the rich, companies, and estates, higher taxes on investors and enterprises. So that's something we'll have to keep an eye on over the next 10 years, increased taxes. However, inflation is perhaps more important than this. For those unfamiliar with the term, inflation simply refers to an increase in the price of goods and services. Do you remember your grandmother telling you about how she used to get a loaf of bread for 10 cents? It is now a ripoff, costing $3. So what is the reason behind this? Inflation, or rising prices. This is what we are talking about. So let's assume that you generated a 10% profit on the stock market the next year. If the inflation was 10%, you would have lost money. Your real return was nothing. And this is why it is so vital to keep an eye on inflation. Printing money, or to put it in more technical financial words, quantitative easing is now one of the leading sources of inflation. Right now, we are seeing a lot of this in the United States. And this is what Charlie Munger had to say about it.
What do you think of the combinations of quantitative easing and large fiscal deficit? And where are they going to lead us?
Well, there I've got a very simple answer, and that is, it's one of the most interesting questions anybody could ask. And we're in very uncharted waters. Nobody has gotten by with the kind of money printing we're doing now for a very extended period without some trouble. And I think we're very near the edge of playing with fire.
If we look at the balance sheets of the Federal Reserve, the European Central Bank, the Bank of Japan, they've all increased by roughly $8 trillion in 2020. Following the collapse of the global financial markets in 2008, it took them almost 8 years to do the same. They completed it in 1 year in 2020. So right now, they're accomplishing something they've never achieved previously, creating money at an astonishing rate, as Charlie Munger puts it. The issue with all of this quantitative easing is that it leads to inflation, since the more money that is artificially pushed into the economy, the greater the demand for items, which will surely lead to price increases at some point in the future. And that is just basic economics. And this is something we should all be aware of as traders because it has an impact on the real return we will receive in the market over the coming decade. The current stock market values will also have an impact on our return. Clearly, if equities are overpriced, our returns will be smaller. As a result, the question becomes whether the market is in a bubble, and here is what Munger had to say about it.
So David Whitner, who is an associate degree in 1975, asked, is the NASDAQ in a bubble and will it blow up? And do we know when? Is the NASDAQ in a bubble?
Well, nobody knows when bubbles are going to blow up. But just because it's NASDAQ doesn't mean it'll have another run like this one very quickly again. This has been unbelievable. Again, there's never been anything quite like it. If you stop to think about it, think what Apple is worth compared to John D. Rockefeller's old oil empire. It's been the most dramatic thing that's almost ever happened in the entire world history of finance.
I'm not quite sure if you remember, but in 2018, there was a long controversy about who would be the initial firm to be valued at $1 trillion. It came from Apple, Microsoft, and Amazon, to name a few. Apple was the first corporation to achieve that goal. However, Apple is now valued at over $2.9 trillion. Microsoft has a market capitalization of $2.5 trillion. Amazon has a market capitalization of $1.7 trillion. So these firms have been growing at breakneck pace, and a lot of people are saying they're excessively overvalued because you're paying trillions of dollars for a company that might be disrupted again and replaced by new technology. Companies, as Charlie Munger puts it, operate like biology, and they all die out over time.
The companies of America behave more like biology than they do anything else. In biology, all the individuals die, and so do all the species. It's just a question of time. And that's pretty well what happens in the economy, too. All the things that were really great when I were young have receded enormously, and new things have come up, and some of them started to die. And that is what the long-term investment climate is. And it does make it very interesting. Look at what's died. All the department stores, all the newspapers, U.S. Steel, John D. Rockefeller's Standard Oil, the pale shadow of his former self. You know, it's just like biology.
So
they have their little hour, they have their little time, and then they get clobbered.
So how can we strike a balance between our investments? Do we invest in disruptive startups if we know that some of the companies will die as a result of this disruption? Do we put money onto firms that are likely to be disrupted? What kind of look should we go for? Basically, you should attempt to accomplish both. Take a look at the firms and sectors that will be disruptors in the next decade or two. They will alter the way the world operates, and as a result, create a lot of money for investors. However, you also want firms that can't be disrupted or would struggle to be disrupted. Railroads or the food industry, for example. These are industries that have existed for hundreds of years and will continue to exist for the next 100 years. So that's a wise, balanced investment, as opposed to today's investing, when everyone tends to exaggerate their stock market competence. What a bull market does is convince everybody that they're all experts. Take a look at the tremendous profits I've made in the last year. They then brag about their buddies about it. Over the coming decade, the most successful investors will be those who can look at things objectively. They are aware of their limitations and will invest within those parameters.
I spent a lifetime trying to avoid my own mental biases. I rub my own nose in my own mistakes. B, I try and keep it simple and fundamental as much as I can. And I like the engineering concept of a margin of safety. I'm a very blocking and tackling kind of a thinker. I just try and avoid being stupid.
So,
and I have a way of handling a lot of problems. I put them on what I call my too hard pile. And I just leave them there. I'm not trying to succeed in my too hard pile. What I would say is the single most important thing, if you want to avoid a lot of stupid errors, is knowing where you're competent and where you aren't. Knowing the edge of your own competency. And that's very hard to do because the human mind naturally tries to make you think you're way smarter than you are. But partly it's temperament. Partly it's deferred gratification. You got to be willing to wait. And it's a weird, good investing requires a weird combination of patience and aggression. And not many people have it. It requires a big amount of self-awareness and how much you know and how much you don't know. You have to know the edge of your own competency. And a lot of brilliant people are no good at knowing the edge of their own competency. They think they're way smarter than they are. And of course, that's dangerous and causes trouble.
If you look at the comments on YouTube, CNBC, or investment sites, everyone thinks they know everything. Simply look at Jim Cramer. I believe that individuals who thrive in the coming decade will be those who are humble about what they know and don't know. Those, like Warren Buffett, who stay inside their sphere of expertise. They are aware of the dangers associated with market pricing as well as inflation, and they invest prudently based on what they know. Let's see how many people are still investing in 10 years. And I hope those of you who are viewing this video will be among them. And with that, today's video comes to an end. To express your love and support for this video, click the like button, subscribe, and hit the notification bell next to it to be the first to know when a new video is posted. Thank you for taking the time to watch. We hope you enjoyed it, and we look forward to seeing you in a future episode.